Since the beginning of 2026, Fiverr stock has already dropped more than 40%. However, as they say, every crisis is also an opportunity. Now, would that be the case here with Fiverr? Well, honestly, I do think so. As you know, I'm long in Fiverr with an average price of $24.52, and as I will explain today, I believe this sell-off could be a great opportunity for me to increase my position. So in today's video, first we'll talk about why Fiverr stock has fallen so much, and then I will share with you my trading plan. In any case, as always, nothing in this video is investment advice, okay? And with that said, let's get started. So first, what's happening with Fiverr? So Fiverr stock is collapsing because of the growing fear of AI. As you guys know, Fiverr is a freelancer's marketplace, right? However, many of the tasks that were previously done by freelancers, especially the simpler ones, such as image editing or text translation, are now being done by AI. And well, as a result, hiring someone through Fiverr is becoming increasingly unnecessary. Because of this, investors now fear that Fiverr's business may be doomed. That's why many are selling their shares. Now, is that really the case? Is Fiverr actually done? Well, not exactly. You see, what most investors are ignoring is that Fiverr is actually going through a transformation phase, which we will now understand in 3 key points. But yeah, Fiverr is evolving. First, the company is drastically changing the kinds of services it offers. You see, it is true that simpler projects will likely no longer generate meaningful revenue for Fiverr over the long run. That's obvious. However, Fiverr is adapting to this new environment. That's why their goal now is to focus on highly specialized work. So instead of being a platform for low-end tasks, such as removing the background of a photo or remixing a song, Fiverr now wants to become the place where big companies hire highly qualified professionals for tasks like testing a new AI system. So that's Fiverr's plan to become more resilient in this new AI era. And as the company mentioned in its latest conference call, this segment of more complex tasks has been growing quite rapidly, at double-digit rates. For example, as they state here, buyers spending over $10,000 annually grew 7%, and GMV from projects over $1,000 increased 23%. Now, many will say here that in the end, that doesn't matter much, since this new segment represents less than 15% of their marketplace. So you could argue that even though this new division is growing considerably, it will simply not move the needle. And well, that's fair, right? However, let's not underestimate the power of compounding over time. Yes, this segment is still relatively small today, but if it continues growing at the same pace over the next 5 years, it could end up representing about 30% of the entire marketplace. And that's assuming growth doesn't accelerate. In any case, Fiverr is pretty aware the environment is changing, and the company will not try to save the $5 gigs in an attempt to swim against the tide. No, instead of that, they are bringing more resilient jobs to their platform, tasks that will have a higher chance of surviving the AI threat. However, that's not the only thing Fiverr is changing. You see, Fiverr is actually restructuring the whole nature of its business model, evolving from a purely transactional marketplace into a workflow platform. Now, what do I mean by that? Let's recall that until now, Fiverr has been operating this way. You search for a service on the platform, hire a freelancer for that specific task, and well, that's it. No recurring revenue, just a one-time transaction. Now, however, the company's goal is to become the place where the entire workflow is managed, like Jira, for example. In other words, Fiverr no longer wants to simply connect freelancers with clients. Instead, the company wants to provide the operating system where the entire project is managed. And this shift matters for 2 main reasons. First, it brings recurring revenue, which makes the business far more predictable. And secondly, this new model also locks Fiverr's clients into the platform. Now, what do I mean by that, right? You see, in a traditional marketplace, if a client likes a freelancer, they might try to contact that person directly next time, bypassing the intermediary, in this case Fiverr, in order to pay less. However, if Fiverr becomes the operating system where the entire workflow is managed, leaving the platform becomes much harder. After all, the whole project is being managed there, sometimes for months. In other words, with this change, Fiverr's business model becomes much stickier and as a result, much more resilient as well. Now lastly, the third key change Fiverr is promoting is related to the growing share of service revenue. As we can see here, back in 2023, their service division accounted for only about 15% of total revenue. Today though, that number has already jumped to roughly 31%. Now what exactly are these services? What does this include, right? Well, here we're talking about Fiverr Ads, for example, which is a tool freelancers pay to boost their visibility on the platform, or about Seller Plus, which is another tool that gives freelancers access to advanced analytics. And why is this growing service revenue important? Because it brings more diversification to Fiverr's business, reducing the company's reliance on lower value gigs, which, let's recall, are more exposed to the AI threat. And here, once again, we can see Fiverr strengthening its business model and becoming more resilient. So basically, these are the three main changes Fiverr is making to its business. With that said, before I share with you my trading plan, let's come back to our initial question. Is AI really killing Fiverr? Well, I don't think so. Yes, it is true that marketplace revenue may decline in the coming quarters. However, as you've seen, this will likely be offset by the growing revenue from the other business segments. Now, of course, you could argue that these new divisions will not fully compensate for the decline in simpler marketplace tasks. In other words, even if these new segments continue to grow, it is possible that Fiverr's overall revenue could still stagnate or even fall. However, this wouldn't represent the end of Fiverr. And here many might think, well, if that's the case, if Fiverr won't grow, then it's not worth investing in the stock, right? Well, in my opinion, that's not quite right. You see, just because a company is not growing doesn't mean it has no value. And with that said, I think it's time for us to talk about Fiverr's valuation. You see, yes, it is true that Fiverr's prospects are not exactly brilliant. However, everything has a price, and Fiverr has reached such an extremely pessimistic valuation that, in my view, even if revenue falls a little, this stock could still be a good buy. Now, what do I mean by that? You see, actually, Fiverr is a very profitable company. For instance, as we see here, in the last quarter, Fiverr's gross margin came in above 82%, which is excellent, while its operating and net margins came at 12% and 10% respectively. Both record numbers. In addition, Fiverr has been consistently generating free cash flow, delivering positive numbers quarter after quarter. And by the way, Fiverr's free cash flow margin stands at around 20%, which is great. And finally, the company also doesn't have any debt problems. As we can see here, Fiverr has a negative net debt, which means it has more cash than debt on its balance sheet. In other words, yes, revenue from low-end tasks is indeed falling. However, as you can see, Fiverr is still a beast, and its numbers are still very strong. Meanwhile, Fiverr is trading at an incredible enterprise value to free cash flow multiple of just 1x. Honestly, it's quite hard to find a company trading at such a low valuation. I mean, even if we exclude these 51 million in stock-based compensation, Fiverr is still trading at just 2x enterprise value to free cash flow. Again, that's a very low multiple. So yeah, the market might be worried about the effects of AI on Fiverr's business. But in my view, I think it is overreacting. So with that said, first, no, I don't think AI is going to kill Fiverr's business. And second, yes, I do think this stock is very cheap. Now finally, after all, what's my trading plan? So first, I won't sell the shares I already own, like many people are doing. Instead, I will keep holding my position for the long run. With that said, I also plan to buy more shares. Now, where do I plan to buy more shares? Will I just buy them at the market? Well, no, I actually prefer to wait for the stock to drop a little. Now, if the stock is already so cheap, trading at just 1x enterprise value to free cash flow, why would I wait for it to drop a little more? Because you see, as you know, I actually have two portfolios, one that is mine and another one that belongs to my family, which I obviously tend to be much more careful with. And at the moment, the most important thing for me is to ensure medium-term liquidity for my family. So I will only buy a stock if its valuation is ridiculously, extremely depressed. With that said, that's what I ask myself. What would be an irresistible price for me to buy Fiverr? A price where I could invest calmly, with no stress. Ask yourself that question as well. Even though Fiverr does face the AI threat, what would be a ridiculously cheap price for this company? For example, would you be willing to pay just 1 times free cash flow for Fiverr, even after accounting for share-based compensation? Well, I would be very happy to make that deal. At that valuation, I would feel extremely comfortable buying the stock. So, at what price would that actually correspond to? Well, according to my calculations, for Fiverr to trade at just 1 times enterprise value to free cash flow, adjusted for share-based compensation, this stock would need to fall to around $9. So my plan is simple. I will just place an order at $9 and wait for the price to get there. If it gets there, great. And if it doesn't and the stock just keeps going up, I will also be perfectly happy with that too. After all, let's recall, I'm already positioned, right? And in that case, I will simply deploy this capital into other opportunities. For example, right now, I'm looking at 2 stocks that are trading at such extreme valuations that their enterprise value is almost negative. So, to close this video, that's the plan. I'm going to place a limit order at $9 and well, let's see what happens, right? But at that price, I would feel extremely comfortable putting my family's money into Fiverr. So no, I don't think Fiverr is finished. That's it for today, and see you next time.